The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box. I'm Karen Cho with Steve Sedgwick at Arabi Lake Amede. We're live in London and Frankfurt today with Annetta. These are your headlines. A tech-led rebound on Wall Street pushes Asian chipmakers higher after Nvidia CEO Jensen Huang tries to put investors at ease over its delayed Blackwell chip production.
If we could fulfill everybody's needs, then the emotion would go away. But it's very emotional. It's really tense.
US inflation falls in August while core CPI surprises to the upside. Goldman Sachs CEO David Solomon tells CNBC exclusively he remains in the soft landing camp.
I'm still in the soft landing camp. I think that is the most likely scenario. I can't tell you that there can't be a disruption or something that can set that off.
OpenAI, wait for it, is reportedly in talks over a fresh funding round. Now, you've got to remember what the revenues are at this company, and I'll talk to you about that in a few moments' time. But the Chat GPT maker is apparently going to be valued at $150 billion.
The ECB lines up its second rate cut of the cycle as markets eye another 25 basis points move lower, with the UBS CEO Sergio Ermotti reinforcing that view in an exclusive interview with the CNBC.
In general, also for the ECB, the inflation topic is still open, so I would say probably a cut, but not as the market expects.
Good morning, everybody. Good morning, Karen.
Good morning.
Happy Friday to you.
Thank you.
Look, yesterday was one of those brilliant days where the debate that you and I and other of our correspondents and guests have on a daily basis, it really came to fruition. Let me just explain. It was like, we talk about, is it data-driven? Are we being driven by the Fed and the data? Or is it about AI and Jensen Huang and Nvidia? And the great thing that happened yesterday is it was both. It was both yesterday. So the downtick part of that, I don't want to reveal anything because Karen's going to show you the markets in a moment, but stunning reversal on these markets, or stunning rebound, I should say. And the range is extraordinary. Again, Karen will talk you through that as well. But it kicked off with, CPI. Wasn't quite what we wanted. We wanted a really dumb figure so that we could have 50 basis points. And the market really down about it. And then suddenly Jensen Huang saying, things are great. And it was just a tale of two stories, the two stories of the year.
But the reality is we only needed an okay figure on CPI to really have confirmation of a rate cut, whether it's 25 or 50 basis points. So enough really, I think, in the data. But to your point around AI, there's been a lot of disappointment. I've been saying that if you look at the semiconductor ETFs, they've really come right back and in fact below some of the August levels that we had in the sell-off. So in terms of the door opening for those who might have wanted to load up on a few more semis, if they had not put them in the portfolio in the same amount as other investors, they got that moment on the back of some of the selling we've had in September. So to have some bullish comments again from Jensen Huang soothing some of those nerves, that was a buy signal, I think, for some investors.
And then my ludicrous headline. Can I read it again? Can I read my headline again? OpenAi is reportedly in talks over a fresh funding round that would see Chat GPT make a value at $150 billion. That means nothing to you, $150 billion, until we give you some analysis on it as well. But I'm not going to yet. But all I can say is, wow, that's fruity, to say the least. Anyway, the markets.
Yeah, but of course, where's the money coming from? It's just a handful of massive AI players already. So I think that, for me, is the fascinating part. I want to take you to what we saw on the markets, and you can see for the likes of the Dow, it was a modest range, but where you saw really the big gains, those tech-heavy players in the market, it was the Nasdaq carrying the markets forward and taking with it the S&P 500. Big moving stocks, Microsoft and Nvidia, those two big AI players right at the forefront of both indices, Microsoft for the Dow and Nvidia for the S&P 500 and for the Nasdaq. So it certainly was a day to scoop up some of those names for some traders. In terms of what we saw on the market intraday, it was actually a fall out of the gate. So some of that weakness in the sentiments materialized very early on and looked like it could be another day of skittish sentiment. But we then saw the rebound. You saw very quick, swift moves across the course of the day, one direction up after it got past some of that morning rout. To those big US tech companies and in particular Nvidia. And don't forget, we were talking about just how much the stock had reversed in recent weeks. Despite concerns around the valuation, everything has a price. And you saw yesterday, as a result of the selling in recent days and sessions, the stock going in the opposite direction, flipping up to the tune of 8%. And it's been, funnily enough, the one stock that's not been a driver for the semiconductor ETFs in recent weeks. In fact, it's been more of an undertow to the performance. But yesterday, back in line with what we've seen in the last number of quarters, the last year or so, real top performer in the basket. Well, Nvidia CEO Jensen Huang says there is a lot of tension in the market amid robust demand for AI chips. Speaking at Goldman Sachs's Communicopa conference, Huang said there's a lot of responsibility on his company's shoulders.
Demand is so great that delivery of our components and our technology and our infrastructure and software is really emotional for people because it directly affects their revenues, it directly affects their competitiveness. And so we probably have more emotional customers today and deservedly so. And you know, if we could fulfill everybody's needs, then the emotion would go away. But it's very emotional. It's really tense.
Asian indices look like this, as you can see. Big gains in Taiwan, TAIEX up 2.8%. Then Nikkei putting on 3.3%. Lovely to see Emily, who's going to join us now, talking about these chip makers driving gains across Asian equities. Emily, lovely to see you from Hong Kong.
It's good to see you too, Steve. And the gains that were playing out in the semiconductor space on the back of the commentary coming through from Jensen Huang. Now, we heard from TSMC a day earlier together with the company's August sales, and it was already a record high, $7.8 billion for the month. But that wasn't enough because the shares, investors reacting negatively with the losses, about just fractional losses playing out in TSMC the day earlier. But then comes along Jensen Huang speaking at the Communicopa event with Goldman Sachs, and then bam, look what happens. Nvidia shares pop 8%, and bringing with it all of the semiconductor space across North Asia. We're seeing Taiwan Semi today up 4.6%. We got about 20 minutes to go left in trade in the market here. We closed up shop at 1:30 local time. Over in South Korea, it's SK Hynix that's leading the charge. And then over in the Nikkei, of course, we got a number of semiconductor plays there as well. But for TSMC, as I mentioned, also running on the fact that they saw record sales for the month of August, $7.8 billion. And Blackwell demand remains strong. Those words coming through from Jensen Huang. TSMC saying that they are seeing sustained demand for Nvidia AI chips and that they have been on track for their Q3 sales guidance. That's $22.4 to $23.2 billion. Now, C.C. Wei on his own part, in an internal memo to his staff, expressed gratitude for good results in the first half and also saying that they achieved enviable success, but there is still room for improvement. And what's also interesting here is he also said that they're no longer a Taiwanese company and that they are a global one. This as they build out their factory over in Arizona. There's 3 there under construction in Japan as well as in Germany, but it'll be until next year when Arizona's first fab comes online in the first half of next year. Look at that. SK Hynix shares up 7.25%. We got Taiwan Semi shares up 4.8% and Tokyo Electron up 4.5%. So really it is a unified positive performance that's playing out here, supported by what, of course, came through from Nvidia and Jensen Huang talking about Blackwell. Back to you guys in London.
Emily, thank you very much for bringing us the update. Let's come back to the macro as the US inflation fell to its lowest level since February 2021, rising 0.2% on the month. The 12-month rate eased 40 basis points from July to 2.5% in August, below estimates and at its lowest level in more than 3 years. The greatest gains were seen in shelter and food, while gasoline and used vehicles each saw declines in excess of 10% on the year.
US Treasury yields rose following the data, with spreads narrowing as traders slashed their bets on a potential 50 basis point cut from the Federal Reserve next week. Traders are now seeing an 87% chance of a 25 basis point move. Well, speaking to CNBC, the Goldman Sachs CEO David Solomon outlined his expectations for rate cuts this year.
I certainly see, 2, maybe 3 cuts as we move through the fall. I think to go further than that, it's really going to depend on, are we continuing to make progress, or is inflation, more stuck at 2.5%? And that, I think the Fed will watch the data. We'll watch the data and we'll see.
James Pomeroy joins us now, Chief Economist, HSBC. James, when we talk about this 2.5% inflation figure, we're not back to 2% target, but it is the lowest level since February 2021. It was last month, I think, in the market event we're having, where a lot of investors are saying, look, inflation is done. We're all worried about growth now. That is yesterday's news. Do you think we had confirmation in the data yesterday that, in fact, we are done when it comes to inflation?
I think not necessarily just in the data yesterday, but over the course of the last 3 or 4 months in the US, there's been some really, really encouraging data points, particularly those headline inflation numbers that are running at a rate that is closer to 2% over that period. But even on the core side, if you strip out the rental inflation data, which we all know are a bit of a challenge given some of the lags that are built into those data, then again, you're looking at numbers that are at or below 2% over that period of time. So I think there's a lot of encouraging news within that inflation data, even on the core side at the moment. Durable goods inflation is deeply negative, and a lot of services inflation has come down as well. So plenty of good news, I think, in that inflation data.
The market, though, has been looking for confirmation as to whether this is a 25 basis point rate move from the Fed coming up or a 50 basis point reduction. When you look at where we are on the Fed funds rate, we're about 3% above the preferred gauge of inflation for the Fed. Does that just set the scene? Does it really matter if it's going to be 25 or 50, because there's plenty of room for the central bank to cut?
I think for us, there's no real need to rush into this. You can start a cutting cycle because inflation has come down enough, but you're only going to start cutting rates really aggressively if you're really nervous about the growth outlook, if you're really nervous about something going wrong. And there's little evidence to us that that's the case. So I think you have to look at this sort of the inflation data alongside the sort of growth data, the labour market data. And yes, there's been a clear softening on that activity side, but there's nothing there that makes us think, okay, this is an economy that's tipping into recession, that's seeing a massive slowdown in activity, and therefore needs an aggressive pace of rate cuts. So we agree with that market pricing now of a 25 basis point move next week, and then a slower pace of easing in the course of the coming quarters, simply because the US economy is probably proving a little bit more resilient than maybe is put into those market expectations.
Which is good news, and I keep trying to remind the market that if it's resilient, that's good news. I know they're desperate for the cheaper money. Look, James, the University of Michigan Consumer Sentiment Index popped in August after 5 monthly declines, and it just shows that there are two-way risks for the Federal Reserve. I've got this horrible feeling that there's a groupthink going on at the moment. That everyone thinks the data's moving in one direction as well, and that we're going to get this steady stream of weaker data skirting recession. Everyone seems to be in this kind of bell curve distribution in the same place. I have this concern, and in fact it's a positive thing, that actually data could be much better than expected potentially, and as such this triumvirate of rate cuts followed by loads more in 2025, it may not happen.
I think that's a fair point. If you go back over a year ago, a year and a half ago, there was this universal acceptance in markets that we were going into a recession in the US, and it was almost taken as 100% guaranteed. And that was because people looked at some of the weaker manufacturing data, and we looked at the impact of historically higher interest rates, and we said, okay, we're definitely going to get a recession. Not only did we not have a US recession, we had a year of very strong growth out of the US. And I agree with you. I think there's some upside risks as well. Don't get me wrong. There are definitely some downside risks in the economy, some of the cracks potentially in parts of the labour market. But at the same time, we're talking about an economy here that has some upside risks as well. Real wage growth is positive. We still think there are quite a lot of savings still in the pockets of households. You look at rate cuts coming through, what that could do to things like the housing market. You've still had a reasonably decent run up in manufacturing construction in the US that could lead to jobs and output further down the line. So I think there are downside risks. There are also upside risks too. And when you think about that, actually for us, that leads you down the path of a shallower cutting cycle, but for good news reasons. This is a US economy that's ticking along, maybe at a slower pace of growth, but still at a positive pace of growth that is good news for consumers and for businesses.
And I think a lack of liquidity is getting people all skittish at the sidelines as well, plus the algos getting involved. James, tell me about this wall of money that needs refinancing, or is there one? Because every single year of the last 3 years, I heard everyone say, well, it may not be this year, but next year, the refinancing is horrible. Wall of money at these higher interest rates is going to be very painful. Is it?
I think Well, it could be, but I think the way we've had loads and loads of examples across the world of how the higher interest rate costs have impacted different sort of household sectors and business sectors. And you can see it really clearly in some very interest rate sensitive economies. Like Sweden is our sort of flagship example of this, where high interest rates really, really hurt the economy hard and fast. And you can see that very clearly. But here in the UK, we've had a sort of similar-ish story to what people are talking about happening elsewhere, where you've had this sort of slow burn of higher sort of mortgage rates and borrowing costs filtering through to people because of the structure of the mortgage market and the structure of lending. And it's been a little bit painful, but it's not necessarily been the thing that causes the world to end and the economy to go into a sharp downturn. And I think we're talking about a similar situation in the US, where it's a potential downside risk if you do have people refinancing, interest rates rise. But actually, it's probably not enough of a volume to offset those other positive things that are happening in the economy. And of course, by the time we get to the middle of next year, interest rates could be 150 basis points lower, which could be actually quite a good thing as well in terms of taking some of that stress out of the economy. And particularly for those households who have really suffered from higher interest rates on auto loans and those sorts of things that have had to be refinanced a little bit more readily already.
James, there are other central bankers in the room today, and namely, of course, the ECB who waited out for moves today. But the Bank of Japan's been very active talking, and this is from one policymaker, Tamura, who is saying that effectively the interest rate must be lifted to at least 1% by late next year. We keep talking about how the market was roiled by the Bank of Japan, that it needs to go slowly as we get more hawkish commentary from policymakers. What does that do? Because it's not moving the needle on dollar yen today.
No, I think there's already a bit of an expectation in markets the Bank of Japan will keep raising rates. We think they'll get just shy of 1%, but they're going in that direction. They've clearly got a window. If you want to get rates up, you've got to do it now, because inflation data could well come down in the course of the coming year or so, and the growth data have been a little bit patchy. So it's now we're in this situation with the Bank of Japan where you've just got to get on with it. But I think there is some hesitancy in the market to believe that they can keep tightening as much as maybe that 1% or potentially higher that they seem to want to do at some point. I think there's some hesitancy there just because of that history with inflation and what we've seen happen to the inflation data in other parts of the world. We've just been discussing about the US, where inflation looked like it was staying high for quite some time and it came down quite quickly. And I think those lessons are a concern maybe when thinking about the Japanese inflation story, where we could see those inflation numbers come down more quickly in the course of the coming years. And if we did, then that tightening is certainly not going to be delivered. So I think markets and us too, we want to see a little bit more evidence of a sort of a proper reflation in Japan, not just on the inflation side, but on the growth side, that makes us think this is a little bit more sustained.
Yeah, maybe what we're seeing on the boards is just a story of how far dollar yen's already travelled just in the last 2 months or so. James, thank you very much for joining us. James Pomeroy, Chief Economist, HSBC. Arabile.
Well, Karen, coming up on the show, how many times have we spoken about this? Trouble on Capitol Hill. US House Speaker Mike Johnson postponing a vote on a temporary spending bill, and now raising fears over a partial government shutdown again, and this time before the end of the month, and of course, with an election nearing. Plus, is the ECB ready to cut for a second time? We're counting you down then to the lender's rates decision this afternoon. We've got Aneta covering that story then for us. Plus, a potential second rate cut then could actually have major implications for European real estate market. We'll find out why with the CEO of Mark, who's joining us on the show at 9:15 CET. Stay tuned. This is Squawk Box Europe.
OpenAI is reportedly aiming to raise more than $5 billion from investors, which could include Apple, Nvidia and Microsoft. That's according to multiple sources, including Bloomberg and the Financial Times, which suggests the startup has been involved in discussions with investors about a potential fresh round of funding for a few weeks now. Reports suggest OpenAI is targeting a valuation of $150 billion, which would represent a huge surge from the $86 billion it was valued at the start of the year. So we're talking about a 74% higher valuation in a short period of time, just as we've been questioning where valuations have gone elsewhere. So this one seems to be somewhat protected in valuation world. In terms of what it means, though, you've got three companies here that are already involved with OpenAI. And this is a cozy old club as we talk about AI, isn't it? In terms of the names cited. So Nvidia. OpenAI is a major customer of Nvidia. Does that raise red flags for anyone? If one of these companies, OpenAI, stops ordering, then what does it do for Nvidia? The company is also potentially going to invest in it. That's interesting. Microsoft, we had the $1 billion investment from Microsoft into OpenAI originally, and then a multi-billion investment after that in 2023. So again, fresh links there. And of course, Microsoft is also linked to Nvidia through its ordering. So again, there is this three-way circle between these companies. And Apple relying on OpenAI for its intelligence, for powering its AI of the future. So to me, it looks a little bit too cozy. And do you want these investors also entwined?
I hear you. So I'm just doing some quick maths. 400, 650, 700 billion. The hundreds of billions of dollars that those three companies, Nvidia, Microsoft and Apple, generate every year, investing for a 5 billion round in OpenAI is chump change.
Yes.
So they can afford to do it. So it's not like most people. This is kind of like, probably all tax write-offable or somewhere down the line with their
like
clever
a
account.
coin in the well,
So so for them it's like a drop in the ocean. But for us, we have to analyse the actual what's going on here as well. And there are many, many red flags. If we weren't billionaire, multi-billion dollar revenue generating big tech companies. One, how much does OpenAI charge for Chat GPT at the moment? So we're right at the revolution. The answer is nothing for the. Hang on, bear with me. For the starting product, I know there are various tiers and pluses and things you can add on, but the fact of the matter is, right at the start of the revolution, we're talking about a free product. And I just went on to a well-known search engine, not owned by those companies, and it just gave me straight away 18 Chat GPT alternatives in 2024, our best free and paid options. So there's a lot of people doing this out there. So my first thing is it's not a lot of money to the people raising it. Two, there's a lot of rivals out there offering free products. Three, this isn't Nvidia. And my point is, Nvidia is the only, and we'll come to this story, of course, we're doing a little bit on it already, but this is the only story in town for the chips that can drive this at the moment. And you've spoken eloquently about how the rivals could come up, but obviously it's about the ecosystem as well. So it's not Nvidia. The people investing, it's chump change, and there are free alternatives out there. My next point, and this is the kind of point which I've mentioned probably about 1,000 times over the years, revenues. This is just look at the real world valuation, not fantasy world, because it doesn't matter because we're in some crazy world. Real world valuations, they're going up a lot. I'm not denying they are going up a lot. They were about 1.6 billion last year. They're going to be about 3.4 billion in 2024. So they are going up. So let's say 4 billion. Let's go. 4 billion times what equals 150? The answer is a hell of a lot, about 37 times. So you're basically being asked to buy this company on an extraordinary multiple. Now, I appreciate it can grow into the valuation, like a lot of these companies do, but on a product that there is a lot of alternatives out there as well, a lot of very cheap and free alternatives as well. You're being asked, if you are an investor at this round, valuing at 150 billion, up from 86 billion, which seems an extraordinary leap even for a company like this. You're being asked to basically have this most enormous hold your nose, dive in, leap of faith on a valuation which is extraordinary.
I'll throw one word back at you, antitrust. This is another concern, isn't it? I mean, we've just seen a whole bunch of cases this week where the European regulators had a massive issue as to how Silicon Valley has been conducting business in recent years. We talk about Apple here, and we just saw a product launch this week, a product launch that came without the AI-enabled bits, all the sizzle, the whole reason why you would upgrade. And who is Apple relying on to execute on this? OpenAI. So what? It doesn't work without the investment, that they can't get to the scale, that they can't get to where they need to without the Apple money? I mean, doesn't that again raise red flags? So both Nvidia and both Apple need OpenAI for their business model. And the only way to get it there would be potentially to invest in this company. I mean, in any other situation, the market would be stepping back and saying, I'm sorry, that is not on.
Yeah, and that's a great point. And look, Apple kind of has to absorb the cost, because if you're going to offer an AI-enabled 15 or 16, the new one 16, then and you're selling the handset at roughly the same price, you can't immediately say, well, by the way, if you're going to use this as a SaaS, because we know where SaaS is, or software as a service, we're going to actually charge you extra for this, and you've got the high price of the handset as well. So I think at the start of this process, a lot of the people who are offering AI product, they've kind of got to just kind of take it on the chin and say, this is going to be a cost that we have to take in, because that's what the clients want.
I should probably flesh out my point around antitrust, because the point here is that if you're going to invest then from these major companies into the success of OpenAI, where does it leave those doors being open to other major players on their platforms. And that's with Nvidia working with other partnerships. It's with Apple using other rival services that you've just mentioned. Let's push on to Google, because as I mentioned, antitrust has been huge in Europe. Google has been placed under investigation by Ireland's Data Protection Commission over the processing of personal data when developing its AI models. The inquiry is set to determine whether Google broke the EU's data protection rules as EU regulators continue to step up scrutiny on tech giants. And of course, earlier this week it was around antitrust when it came to Google. Now, Meta has already limited the use of some of its AI products in Europe following discussions with the watchdog in June. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.